And welcome to everyone. My name is Fred Barstein. I am the founder and CEO at TROW, TPSU, and 401k TV. We have three companies because I haven't figured out a good enough name for all three in one. So just a little lazy on that. And really excited to have you part of 401k Cafe. We've starting this series. We wanted to have informal talks, not webinars, on subjects that we think are really, really pertinent. Nothing is sponsored, so we're not trying to get anybody's message out there, and no agenda. The agenda is we want to try to find topics that might be interesting to you. And if all you guys ask a lot of questions and you hijack this thing, then all the better. So we want to know from you. So that is 401k Cafe. We also do a similar series for plan sponsors on the role of an advisor and the importance of RPA due diligence, which has been resonating and getting lots of questions about that. But that's a topic for another day. I am pleased to introduce, though it needs no introduction, Dick Darian. So we brought the wise rhino out of hibernation. I don't know if rhinos do hibernation, but this one does. So he's really been enjoying his family and the time off, but he's done me a huge, huge favor and is here. And Dick is the founder of Wise Rhino. Before that, he was the head of DCIO for BlackRock, and before that at one of the co-heads of NRP, and before that at MFS, the head of sales for MFS before they had a record keeping, and was part of the group that was sold to I can't even remember the name, Reliastar, that was sold to what is now Voya on the time. So he's been very instrumental in a number of industries, changing the whole advisor M&A, the way that advisors, aggregators, but also I think he really revolutionized the DCIO market when he was at BlackRock. Really incredible thought leader and made some significant changes. So welcome, Dick.
Thanks, Fred. Good to be here. And some of that was true.
Some of it. We won't say which ones. We'll let all of you figure that out. So getting right into it, you were really on the cusp of when the RPA, M&A market took off. I mean, it started back at, probably CapTrust was doing it and has been doing it for, almost 30 years doing it, but it seemed like it picked up. Tell us, when it picked up and why did it take off? Because it seemed to be taking off. It seemed overnight, but nothing, as we know, happens overnight.
Yeah, and Fred, first of all, thanks for having me here today. And to everybody listening, I looked at some of the names, and it's good to see everybody. And by the way, there's a great life after retirement. We're all in the retirement business, but I'm mostly retired, although that's a relative term, and enjoying every minute of it. So, but thanks for having me, Fred. So, Fred, you and I started talking about, I remember you came up with one day, you showed me the academic work by Harvard and some of the other firms around the consolidation curve. And, as you and I would talk about that, it kind of opened my awareness to what was going on in other areas. And, the closest, we all knew about record keeping and that consolidation. But I was more fascinated with the national investment consulting firms like Mercer and Aon, and seeing what was going on with them, and it wasn't just that they were buying up the smaller boutique regional investment firms and continue to do that. And again, these are firms that focus in the mega market and tend to be consultants. But I was fascinated with the fact that their whole service model was changing. And if you go back 20 years ago, Mercer was coming into a BlackRock where I worked and saying, look, we'll advise you and your 401k plan, defined benefit plan. And over the last 20, 25 years, their business was remodeled to be more OCIO, and more investment product, and more not just ordering the menu, but actually cooking the food, right? And they did that because they could, And they also did that because the economics on providing, the fees, funds, fiduciary was changing rapidly. And certainly those firms had to figure it out, and they did. So they pivoted to OCIO. And I thought even the more fascinating part was that the act of doing that was going to change the game for everybody else, and it did. In fact, I remember some of the last firms that, when I was still engaged day to day, that we represented, two of which sold to CapTrust. These were very large regional consulting firms that had Fortune 500 clients and had gotten to the point where they weren't sure if the advice they were giving to the fiduciaries was really as valuable as it used to be. And the independent concept, Fred, of being independent from investments, their clients didn't care as much about that anymore. So they were beginning to think, why are we so hung up on just being advisors when maybe we can get more involved in the more lucrative aspects of the business? So you and I would have those conversations. And so that was kind of step number one, is that, any industry that can consolidate will, for all the reasons. It's usually economics. And you and I, as we began to talk in the the mid 2000s, began to see some of the firms that getting bigger. And one of the first firms to really realize their market value was Sheridan Road. And Jim and Daniel were very thoughtful and really saw kind of the opportunity with some of these aggregators. But it really took 20 to 25 years from the late 90s for there to be big enough retirement advisors firms to be worth it for someone to acquire. So that was the first thing. And then the second thing was, money coming into the space, the success that private equity had, in employee benefits and PNC, and then onto the larger investment consulting firms and so on. So you had this, this convergence of all of these things, the sellers being big enough, the sellers getting old enough, demographics, the buyers kind of organizing, they were acquiring, they started to say, hey, wait a minute, we can also bring in, we're in the C-suite already with benefits. Why not 401k? So there were 4 or 5 things, including demographics, that kind of all of a sudden came to the table. And then when the money was available, Fred, suddenly you had this market where you had all sides kind of pushing. And that included the sellers, who many of which were at an age where they needed a succession strategy. So I think that first wave, which really started in 2017 and 18, it really went on for 5 years, was this kind of rush to acquire the best firms. And most of those acquirers were obviously the aggregators that were, and many of which were either in, CapTrust as an RA, or the employee benefits and PNC space. So, that happened. It was proven. It was a run on the bank, so to speak. And, those firms now have very large retirement and wealth operations.
Yeah. And I think, overall, the trend that we want to talk about is, that we have the RIA, the RPA, M&A, and it's been pretty prolific in terms of the number of deals. Certainly not as big as the RIA, but there's, 20 times more RIAs than there are RPAs out there. But it's really the effect of convergence of wealth, retirement, and business at the workplace, and how that is affecting RIA, the M&A thing. So, one of the things, and we hear it from time to time to say, hey, convergence is a fad. I've done a poll recently, I do one every Friday, is convergence a fad? And 86% not. So, whether it's a fad or not, and, I'd like to get your opinion, how many firms are actually really doing convergence? And before you answer that question, Dick, do we have any questions, or are we good?
Not currently. We're good.
Okay, cool. So, is convergence a fad? And even if it's not, how many firms are actually doing, wealth, retirement, and benefits at the workplace, are really executing on that?
Yeah. So Fred, when you say convergence, I know that's a word that is being used, and it's such a big word. And, the first thing you say is, well, what is it, right? What exactly is, and Fred, maybe back to you, when you say convergence, why don't you tell me what you think convergence is?
I think it's the opportunity for advisors or providers to work with and service the participants beyond the fees, funds, and fiduciaries and the plan level services, to sell them services. It's as simple as IRA rollovers. It could be retirement income. It could be managed accounts. It could be helping them with HSAs, or, it's beyond the just, helping people save for retirement. Does that make sense?
Yeah, no, that's fair. I just want to make sure we got that out there. So, as you were saying that, I was thinking of, convergence as a noun and convergence as a verb. So convergence as a noun, which is, it's a thing. It's actually an opportunity. It's a real thing, regarding retirement plan advisors who work with, there are 160 million working Americans. There's 100, million in retirement plans. What a huge marketplace. What a great opportunity to work with participants, employees at the work site. So, and then you have wealth operations that, could continue to use clients. And when you think about all the consolidation going on the wealth side, Fred, at the end of the day, like, everybody's providing more stuff, more tools, more support. Everybody's providing, a broader set of capabilities. The key thing is who's providing opportunities with the right clients. And that's always going to be the thing. So convergence as a noun, I think, is an absolute thing. It's there, it's obvious, it's an opportunity. And then if you look at the retirement advisor side, the economics, Fred, just like my example, talking about the Mercers of the world, over time, the economics is going to continue to erode. Technology, competition, commoditization, change, everything. So just the retirement advisor, like the record keeper, like the broker dealer, is going to go through, the continued commoditization and fee pressure, which the wealth advisor really isn't, because it's not a unionized business. It's not this, big bulk buyers buying these services and they want the lowest basis point index fund. So the noun is easy to say, yeah, I mean, it's there, it's going to happen. The verb is actually is the action. How do you do it? And, the first sign of convergence is, it seemed like we did, the last 5 years, Weisner Group has done close to 200 transactions. Almost every one of our RPA clients had wealth business. And that was, Fred, the beginning of convergence. And it was really opportunistic, right? It was the fiduciaries at the company saying, hey, we like what you do. Can you handle our own personal wealth? And it seemed like every practice we took on had some element of that. And they began a bit. And so, whereas 15 years ago, it was 100% retirement, almost no one didn't have wealth business of the clients we took on, even though retirement was their primary. So convergence happened there organically, Fred. So that's the beginning of the verb, the action. And then you go all the way to the other side, which is CapTrust, a firm that had built a fabulous retirement advisory business and very, very thoughtfully and strategically has begun to build not only a organic wealth business or inorganic wealth business through 60, 70 acquisitions, but beginning to engage the participant. And what makes the verb part, when someone says, convergence is a fad, which I don't think it is, what is really hard is actually turning convergence into an organized, systematic, profitable business. And Fred, that is a whole nother story.
Yeah.
Hey, Fred, we do have a question if you'd like to take the question now.
Yes. Yeah.
So we have a question that says, how is this trend with the aggregators going to play out and impact the industry when it comes to your average advisory practice, where advisors who want to retire seek to maximize their values, but are trying to bring in new owners who can't afford to get priced out of the ownership side?
Okay. I mean, I would love to hear Dick's, what I thought I heard, it may not be exactly their question. I asked this question at the first aggregator roundtable. You were there in 2018, right? We were starting. And I asked the aggregators, can independent firms survive with all these aggregators coming, bringing resources? And overwhelmingly, people said, yes, they will survive. They have relationships, but it's going to be harder for them to grow. So that has more to do on the growth. But I think the question has more to do with succession planning and, when they're ready. Did you understand what the question was, Dick?
Yeah, I think so. I would start by saying that, and this Fred, I think allows us to get into the meat of, what's going to happen with convergence. Um, everything takes time, Fred. Look at the record keeper consolidation. How long has that been happening?
20 years.
Okay. If it were put in football terms, what quarter are we in?
Yeah, so it's at the fourth, it's the third of fourth stages. So we're in the
Right.
third quarter.
Right. So we're just beginning on on this side, the retirement side. So I would say, and it's not so much, the easy part, and I've been saying this for years, the easy part is buying practices. The hard part is then putting it together into a business that can actually, execute differently and better. And that includes just, it's hard enough being a really good retirement advisor and serving clients. It's hard enough being a good wealth advisor and serving clients. To then put those two together and build a machine where the two are talking to each other, and that's really hard. And so to answer the question, you know, I think there's plenty of years left for independent advisors, both sides, and that there always will be. But I do believe that there's going to be a point, and there has been in every business where, and Fred, this is part of the academics. Once you have large organizations that are able to do things differently, if Cap Trust, and I've said this to Fielding Miller and Rick Schaff, and they deny it, but when they're big enough, and by the way, this happened at Mercer, where they can make a ton of money on the wealth side, which they are. Right now they're probably making more money on the wealth side than the retirement side, even though the assets are, 80, 20, 90, 10. They can begin to change the pricing for the services that they provide on the retirement advisory side. That begins to impact other people in the marketplace. And that's exactly what you saw on the record-keeping side, Fred. That's exactly what you saw with the national investor consultants. So until that happens, it's business as usual. And I think also with all the private equity firms, there are probably too many aggregators. And what's probably going to happen is over the next 4 or 5, 10 years, you're going to have some recapitalizations, and you're probably going to see the building of larger organizations that can ultimately be big enough to do what a Mercer and Aon can do and actually execute in putting retirement and wealth together. When that starts to happen and that can impact pricing, then the RPAs, Fred, that are independent are going to have a rougher go at it because they're not going to be able to compete.
And I think for advisors, it's sort of three questions. Number one, and I think the question was really good, is should I be selling and thinking about selling, or remain independent? And then once you've said, yeah, for whatever reason, whether I want to sell it, keep it internally or sell it to an external, and it's who should you be selling to? What kind of firm do I want to be affiliated with, whether it's an RPA or an RIA firm? And even if it's an RPA, there's so dramatic differences between the various options. But then I think one of the things that people don't think about is, okay, if I decide I do want to sell, who's the right banker? Is it somebody like a Wise Rhino Group who may know the RPA world, and there are others out there like Marshberry is starting to get involved in that, and they came more from the benefit side, so they know that side, or is it an RIA banker? Because each of them is going to know certain things. So I think just like with plan sponsors, they think of who's my record keeper, what's my investments, who's my advisor, who's that person that's going to be guiding me. So I think it is, those three questions need to be considered. It sounds like
Fred, there was another thing that came to mind off of that question, and it really goes to how all the advisors out there view the marketplace and the opportunity. And I guess my biggest surprise in the past 6 years providing M&A advisory has been how few firms there were. If you think about the stack, and you say there are thousands of practices where you got, and there are, Fred, there are, the folks who have a small hang a shingle and do $500,000 in revenue. And then you have kind of another 1,000 or two doing a couple million and so on. The opportunity and the firms I've seen that have been able to spend their time doing their own M&A and realizing that all CapTrust is doing is buying people at 10 and then putting them into their 20 times box, and they have an immediate accrual of 2x, like instantaneously. And if I was younger and had more energy, I'd be doing that myself. I'd say, well, let me go out and aggregate, and then I'm going to turn that over and sell it for 2 times. So, it's maybe not the easiest game in town, but it's pretty close. And most of the aggregators don't want the 500s, the 400s, even the millions. Yet putting those together, and some people have done it well, and then doing I hate to use the word flip, but selling that business is incredibly lucrative, and also does a favor to some of the smaller firms who actually need help also. So, Fred, it seems that one of the things that we encouraged through the year was to spend as much time on your business as you did on your practice, and focusing on not just, oh, okay, today's the day I'm going to sell, but also kind of let's build the business to a point where you've maximized your business, and then look for a partner. So I would encourage people to look at that. There are thousands of businesses that need the help, and putting them together and then doubling your money is not a bad way to start.
And to one of the things you said, I thought it's every RPA business had some wealth. I think that what I'm seeing, and be curious to see what you have, every wealth business has some 401k or DC practice as well,
Yeah.
right?
Yeah.
It's rare when they have absolutely none. And,
yeah,
the Cerulli numbers are 12,000 specialists who have more than 50% of their revenue, which has been maintaining, because some firms like Cap Trust aren't considered quote unquote specialists because but we know their business. But the 62,000 that have 15 to 49%, they have pretty significant books of businesses. They just haven't focused on it.
Fred, they do. I think in addition, Fred, they have relationships. It's interesting. My neighbor here in South Carolina, two of them, husband and wife, they both work for Hightower. And, I talked to them about their clients. They've got amazing clients. These are CEO, CFOs of large companies. And when I asked them about 401k, suddenly their eyes glaze over. They don't even know if they have that as a service, Fred. Now, these are, this one guy he's with their largest practice in New York, and he doesn't even know so the relationships, yes, they've got the clients, but and as you know, Fred, we've talked about this, it's hard to go from wealth to retirement. Not only hard, but probably not advisable, because you're going to a lower margin business. It's a whole different language, but to bring them both together. And I do think that, as part of the future, you'll see, you're not going to see a Hightower necessarily building a retirement business, but private equity is going to force the combinations of a large RAA and a large retirement business. So you could have a Hightower merge with a Prime Capital or whoever.
Yeah, we are seeing, I think, I've talked like with Carson, they bought not a huge firm, but they bought a $5 billion firm with $4 billion in retirement, Northwest Capital, I think. And they were like, that was their sort of, okay, we've been doing this, we have it, but we haven't paid attention. Now we have to get serious. And to a larger extent, Creative Planning buying the Locked-In, they sort of had a built-in retirement, and you're seeing it with Mariner, when they bought Anco, but they've hired Luke Vandermillen, to build it out. So we're starting to see that. So it sort of leads to the question, why an RAA? Because I know a lot of RPA firms are buying RAs. What's the advantage of an REA going to an RPA firm that may not have a great wealth stack or a real understanding? And then the other side of that question is why an RPA may want to go to an REA firm that may not have a built-out service in tools for the retirement practice. So both sides, if you could address that, Dick.
Yeah, sure. So I think, RIA to RPA certainly, and being the first in, you have an opportunity to engage the clients, the participants, the connections that that firm has, building out a wealth business. And again, depending on what the RIA wants, they could be first in, they could help build that business. but more importantly, the currency that's most important is the referral business they would get on the wealth side. So, there, like I said before, there's kind of a sameness. It's important when you look at the RA stack, Fred, to have the right technology, the right back office, the breadth of services, but there's nothing special there. That's become table stakes, over time. What is not table stakes is the ability to bring in new clients. So, that's certainly the main advantage there. The other way is, I think, the opposite, right? It's if you're an RPA business that sells to Hightower, in the land of the blind, the one-eyed man is king, you're going to have an opportunity to not only lead the charge on the retirement side, but then you've got the referral business, right? But what I would say is, you have to be very careful there. And, all referrals are not, if you think about the referral thread of benefits to 401k and back, P&C 401k and back, the last 5 years has told us that, it's been kind of spotty relative to those referrals, whether it's, CapTrust or Hub or, whoever it is, you have to know what you're getting. And, give you an example. We've had, some of our clients come back and we've done surveys every year. How you doing? What's good? What's not good? And you really have to do your homework. If you're an advisor that focuses on the 500 to 5,000 participant, range, and you're going to an aggregator that focuses on, the 50 to 200, you're not going to get a lot of referral business. And we've seen a lot of that feedback. So you just have to be very, very, kind of careful on where you're going. But the referral business is there, and it's going to take time for that to mature. But I think in those two examples, it's new business, Fred.
And we're starting, it seems like the two-eyed man is going to be the firm that has both RPA support. We take for granted all of that, but that takes a build to have that whole support structure. I've talked to a number of advisors that are part of broker dealers that you would think have that support, but don't, and they struggle because they're, how do I get a financial wellness platform? How do I get, student loan? So you have that, and on the other side, you have a lot of RPA firms that are, even the aggregators who are very, very healthy, strong RPA business or retirement business, but they're still struggling to be able to support. And then the RA goes to them and they're like, hey, where's this, and this? And what is it? They don't even know what it is. So they have to build that. It seems like the firms like CapTrust and Creative Planning, sort of the two that might have really strong on both sides, are going to succeed. But the question I have is, who has a better advantage if it is about the participants? Who is in a better position to be able to actually execute on that convergence? Is it the RPA who has the relationships and hundreds of thousands, if not millions, of participants, but maybe not as great a wealth and business? Or is it the RAs who have a great understanding of participant and investors, maybe higher in, but understand how to work with people, but maybe don't have that huge retirement business? Who would you bet on in that two-horse race?
Fred, I'll answer the question. I'd like to just give you the answer, but let me give you a sense of, so everything's hard. Everything. I mean, everything, right? I mean, ordering lunch sometimes is hard, right? So, especially me, because I like to eat. But it's, I think when you think about all the work that goes into, building these things, you have to keep it simple. And the firms that have a simpler dynamic where they're not, and where the decision makers, Fred, understand the subject matter and they're all over it. So when you think about a CapTrust that has retirement and wealth, and frankly, here they are, Fred, and they're still not doing benefits as far as I know. You don't think every firm in the world has said to them, like, bring in benefits? They don't do the NP&C, and they could kill it, but it would take away their focus. So everybody on this call knows that if you just have 2 or 3 things to do and you kill those things, you succeed. So clearly, the simpler it is, the sooner I think these firms will be successful. So I would say the cap trusts of the world have a better opportunity to execute sooner than the others because they are simpler, fewer distractions, flatter. Fielding Miller is there every day, understands the dynamic. I think if you're one of the insurance aggregators, the guy who's the CEO of the business can't spell 401k. So to me, that's easy. It doesn't mean that that's going to be the answer. I still go back, Fred, and say that none of this is going to happen successfully. None of the, every year I brought the aggregators in for a meeting, and I kind of every year said to them, look, guys, I know this is impossible, but if I were you, I would all come together and have an outside firm build all the stuff you need to build as a cabal, rather than trying to compete with it. And I'm talking about the tech and the infrastructure needed to converge, to engage participants. And I've said the same thing to all the record keepers, Fred, but it hasn't happened because it's impossible, right? So I think it's going to take years, and I think it won't happen till there are bigger firms. But I do think the cap trusts and some of the smaller RAs have a better chance because they're simpler and they have fewer products to worry about.
Right. Well, let's see if we have questions. If anybody wants to, unmute themselves, you can just ask the question, but I don't want to go too much longer. So we have a question. Financial wellness employee education is one of, if not the primary concerns of most HR departments. Shouldn't the wealth management side have a scalable process, have an advantage over RPAs, especially with PAPs and MEOs and MAPs? I think that's it. So he's asking, don't the RIAs and the wealth advisors, financial planners have a better chance of executing on the convergence than the RPAs, who maybe for the most of their time have focused on fees, funds, and fiduciary? I'll let you answer first, Dick. But
Fred, I think as feet on the street and executing once it's built, yes, but not in actually getting the gig. Meaning, I'll go back to CapTrust again. Let's say they have 7,000 clients, Fred. What they've done systematically is gone into every one of those 7,000 clients saying, hire us to be your wellness firm, which is really your advice firm. And once a year, at least, we will do a blueprint. We'll do a gap analysis / financial plan. And that's very much, and by the way, that's the way, to me, wellness has to happen, because that's a base, that's preparation for a wealth advisory gig. Wellness for the sake of wellness is hard, and it's not profitable, right? All the plan sponsors want it, but who's going to deliver it for how much and what's the benefit? Not just the participant, but to the advisor. So I think that, it's the plans, it's the RPA, Fred, that has the relationship to get that gig. I think then you have to execute it, and then you have to bring in the folks who can be on the ground, actually talk to participants, meet them, etc. So that's the way I would answer it. Not necessarily a wealth firm who doesn't have the corporate relationships.
Yeah, so I think the question is, okay, if you've got that relationship and you are the RPA who is trusted and might be the only advisor that that participant ever talks to, if you are in there, who is going to have the advantage, the RPA or the RIA? And you would think logically it is the RIA, because they're used to dealing with individuals. However, the thing that's very difficult, and I think CapTrust is actually, we keep using them, but they only want to go with the $1 million plus, the people who have $1 million or more in investable assets. The vast majority of the DC participants do not have $1 million plus. It might be 90% or even more. How do you bring advice at scale? How do you bring, that wellness or that advice? And I think most of the RAs are used to dealing one-on-one, high-touch service, financial planning, personalization. You can't do that for somebody who doesn't have significant.
Yeah, you look at Fidelity. You deal with Fidelity. If you've got $1,000, you can still talk to someone on the 800 number. But if you've got $1 million, you get an advisor, and that's the way they're going to have to go. And that's what CapTrust others are thinking.
And I think that where we're in, I'm starting to work a little bit on this how does AI come into it? AI, we know, is going to affect all of our lives, all parts of it, but I think it's really going to have a dramatic effect on advice. Not that AI is going to replace a financial advisor, but it might enable them. And anybody who thinks they know exactly what's going to happen with AI is probably wrong. But I think it could be that this does bring advice at scale, or could happen. But I think it's a very good question, and I think it's going to be played out. But logically, I would say it would be the RIAs who, if they can scale it. So before we close, any final questions you have? I think between Dick and I, close to 70 years of experience here. Dick is younger than me, but he has more experience in the industry, and certainly a lot wiser than I am. Any final questions? And you can ask. You can unmute yourself, I think, DJ, right? We don't have to do that for them.
That's correct.
Yeah. Any final questions for the Wise Rhino group before he
Sure.
goes back into high education?
Go ahead here. Are there any alternatives to, joining in with an aggregator for some of us smaller firms? At one time, it looked like there was a subscription-based solution, either through the pension marks, SRPs, et cetera, but they seem to have kind of shifted more towards an aggregator model rather than a subscription-based assistance model. Is there any hope in the future that something like that will come back into the fold? Or do us little firms basically just have to either grow or be gobbled up?
Yeah, hey, good question, Rod, and good to meet you. So, you go back 10 years, there were quite a few of those models. And you think about GRP, and you think about SRP, pension mark, and the challenge, and we worked with all of them, and as we and Vince Morris at RIA. So, I sat down with all those firms and kind of did an economic analysis for them. And the challenge is they were doing great work and providing excellent services, but they weren't making any money. And so scenario, Rod, is like Vince Morris would build this platform, and he was making single digit margins on that. He would make you more efficient, and then you would sell your business because you were now increasing your EBITDA because you were offloading a lot of the stuff to Vince, and he was making no money on his business. So that was kind of the model. And all those firms, whether it was Vince or Troy or Jeff, they realized that. So the next step was, we need to own some of them. So they began to say, okay, we're going to buy a piece of those businesses so we can experience the gain in equity. And then once they did that, they realized, okay, the only way this works is if we own businesses and we make them more efficient. So that's a long way of saying I don't think that model is going to come back. Although you might see the model, to Fred's point, on the wealth side, willing to, I think, the creation of larger firms that are a accumulation of smaller businesses where all of you own the business and, where you build your own platform, but that's really hard to do. So, Fred, I'm not aware of any new platforms, but I think the economics prevent that.
So I do think there are some, but I think that's the way the world has gone. But I think GRP, which is part of Hub, you can join GRP, and it is a subscription, and you do get access to all of it. I think their model there is not like this is a great business, but it's a good farm system for if you're using the GRP tools and services, and then you get big enough and you do want to sell, they think they have an inside track. I'm not speaking for them, but that would be what I'm thinking. There is another group that started relatively recently called Accelerate Retirement. That is started and led by Chris Giovinazzo, or is it Matt? I get them mixed up. But I think it's
Chris. It's Chris Giovinazzo in California. Yeah, that's a good point.
Right.
I would talk to Chris.
You must move your RIA to the NFP RIA, but then you get access to all of the RPAG tools, and it is a budding group, and it is not an ownership. And I don't think any of those firms are, you know, owned, and they go there because for your, Rod, what you asked, they just don't have anywhere else, or they want to be part of a group that has maybe a national brand and has tools and services. And then obviously RPAG, you know, that is a pure subscription. They used to be part of NFP, but RPAG and FlexPath have split off. They're no longer have owned by NFP, which actually just got sold to Aon there. And you can join, and they have robust tools and services. And I think there's less concern about advisors giving their data to a competitor, you know, because when it was owned by NFP, you know, the NFP advisors were out there. So I think there are those three options, and I know that there's another firm. I'm blanking. It was founded just recently by a wholesaler in Boise, Idaho. He was an Empower wholesaler, and it's more for the wealth advisors that say, "Hey, listen, I don't want anything to do with this. I don't know what I'm doing," and he does everything. And I don't think that that's what you're talking, but it may be that he does a lot of stuff with the participants, and there's different models, so you can offload. I think his name is Shane Hans.
Yeah, it's called Freedom Fiduciary, Fred.
Yeah, Freedom Fiduciary, and
Shane
I've been
Hansen.
impressed. Yeah, Shane Hansen, and
Yeah.
I've been impressed with him. So I think there are. We'll let one more question if anyone wants to have the final word.
Excellent answers, by the way. Thank you so much.
Yeah, thank you, Rod. Any other, are you seeing any BDs getting interested in the space with, okay, so we have a question. If for those of you who are willing to stay on, I know, you know, Dick's got nothing else to do. He's a retired guy, so I'm just kidding. Dick and Fred, are you seeing any BDs getting interested in this space and increasing service for RPAs that may join their RBA like? So let me take that like an RBA. We are, we do, and I have done these broker-dealer roundtables. I'm doing my fifth one, I think, fifth next week in New York, September 4th and 5th. So I've been bringing the record keepers together, and it's those that have at least one person and maybe more dedicated to that side. What we heard from them is that they didn't get any support. They didn't get any love from the broker-dealer. They were all focused on the wealth side. That's where the margins were. That's where the interest was. It was a huge turn last November when we had our RPA roundtable in New York City, where they were getting support. They were getting interest because those broker-dealers like a Cetera said, you know, this is going to be important for our wealth advisors. I think the quote that James, the CEO of Morgan Stanley, James, I forget his last name, but he said, the workplace will be the #1 source of assets for wealth advisors, and the next, James Gorman, over the next 10 years. So yes, I think they do. There are some, and I won't name them, who you would think would have it and they don't. So I think it's a greater or lesser extent, and I think that some firms have gone through a transition. So I think it really depends, but we're definitely seeing more resources going into the broker-dealer side, but not necessarily just to support the RPAs, but to be able to support the wealth managers who might come across something and don't know what to do with it, and they need the support. But that's going to result in greater resources. Have you seen anything like that, Dick, or are you seeing that trend?
You know, I would just say that wires, Fred, BDs are notorious for just, I mean, you and I have gone through 5-6 cycles of executives, say at Morgan Stanley, and, you know, great firm and everything, but God, the retirement side is just, and then I would say the independent broker dealers, you know, they seem to be consolidating, and, you know, before I kind of pulled back, there were some of the bigger ones starting to say, hey, we need to create like an internal retirement group where all the business goes to. So, that's just, but the problem with BD is it's not what they do, and they don't have a lot of talent, and they continue to just go through cycles. So I'm not encouraged by any of it.
Yeah, I mean, it is still a wait and see. I remember going to see and I can say the firm because the people have turned over and a lot. It's Cetera years back. And I remember it was 2011, Brian Graff and I were going and trying to get them to join Napa. And the head of it, the retirement, who didn't know retirement, said, we're not even sure we want to be in this business. And I was like thinking in the back of my head, you may want to talk to Randy Long, because Randy Long and Sadria was clearing through Cetera, and I don't think they're going to be real happy with you if you decide you don't want to be in retirement. They're all in the retirement business to a greater or lesser extent, and I think the question is, what's the resources they have? And I think to your point, Dick, it is cyclical, but I am seeing very, very encouraging signs, and I would say it's only the last year that I am seeing that. So with that, I am going to end. Want to thank Dick very, very much. I know that with all kidding aside, he's got his family and all these other things. So he is very selective about what he does. So I very, very much appreciate Dick coming back. And I think for all of us, it's great to have him from time to time, because he has so much wisdom and has done so much and really changed the industry in many, many ways. So thank you, Dick. Thank all of you. And I do want to say, if you have any questions and you would like, to call me or, just bounce some ideas about what you're thinking, Jasona, could you put my email and a phone number?
In the chat?
Yeah, in the chat. But Thomas, did you have
how
a
are you
final?
today?
Yeah, go ahead.
Good, and thanks for calling me back. I think you left a message for me last week as well.
Great. So do we have an appointment on the books with you, Thomas? Is that what you're saying? Okay. So here is my email and my phone number. Can you put that in as well? Jasona, do you have that? 561-371-4902. Please feel free to call me. I'd love to hear from you guys, hear what you're doing. And if there's anything I can do to help, it would be my privilege to do that. So it is on the chat box. I look forward to hearing from you, and we'll continue this discussion in different ways if you find it helpful to have these sort of informal discussions. And we're not going to have these sponsored. These are going to be totally independent, no agenda on this. So thank you all, and thanks again, Dick. Appreciate it.